History rarely announces its turning points with a roar. More often, it begins with a quiet notification, a classified brief, a redacted memo, or, as we saw recently, a Bloomberg report that should give every institutional investor pause. The news is out. The FBI and major banking institutions are currently assessing a breach at a critical real estate finance technology vendor. While the headlines focus on the immediate hack, we must look at what lies beneath. This isn't just about stolen data or a temporary system outage, it is a signal that the structural integrity of the property market's digital infrastructure is under a kind of stress it was never designed to handle. For those of us who have spent decades navigating the cycles of real estate, we know that risk is usually found in the numbers, in interest rate fluctuations or vacancy yields. But today, the most significant risk is not in the physical asset, nor is it in the tenant. It is in the silent alarm currently ringing through the corridors of our tech vendors. We are seeing a collision between the old world of physical certainty and the new world of digital fragility. The FBI's involvement indicates this is no longer a localized IT issue, it is a matter of national financial security. As analytical peers, we must ask, how did we reach a point where a single vendor's vulnerability could potentially paralyze the flow of capital into one of the world's most stable asset classes? There is a specific kind of comfort in the tangible. For the veteran investor, real estate has always been the ultimate hedge because you can walk its perimeter, touch its walls, and understand its foundation. We've spent 40 years mastering the physical plumbing, the HVAC systems, the structural load-bearing walls, the zoning laws. However, this familiarity has created a dangerous blind spot, the illusion of security. While we have been obsessing over the concrete and steel, the digital plumbing that actually facilitates the value of these assets has been outsourced to a labyrinth of software layers we barely understand. We assume that because the building is solid, the transaction is secure. But a property today is less a physical object and more a node in a vast, interconnected digital network. When you look at your portfolio, you see square footage and cap rates. But from an analytical perspective, you are actually looking at a series of permissions, encumbrances, and titles stored on remote servers managed by third parties. We have prioritized the resilience of the physical structure while allowing the resilience of the transaction infrastructure to atrophy. This disconnect is where the danger lies. We are operating 21st century assets on a digital foundation that is far more precarious than the ground they are built upon. In our pursuit of progress, we have fallen into the efficiency trap. Over the last decade, the drive to make property transactions frictionless has been the primary goal of PropTech. We wanted faster closings, automated underwriting, and seamless title transfers. And we got them. But efficiency and resilience are often at odds. In nature, a highly efficient system is often brittle, it lacks the redundancy needed to survive a shock. By streamlining the real estate finance stack, we have inadvertently created a massive, centralized single point of failure. We moved away from the inefficient, distributed systems of the past, where local banks and physical archives provided a natural firebreak against systemic collapse, and moved toward a centralized model where a handful of vendors manage the majority of the market's data. This centralization is the efficiency trap. It feels like progress when things are moving fast, but when that central node is compromised, the entire system grinds to a halt. For a professional who understands the value of long-term sustainability, this is a sober realization. We have traded the safety of decentralization for the speed of the cloud, and the Bloomberg report on this FBI investigation is the first real bill coming due. We are now seeing the cost of that frictionless experience, a system where one crack in the center can bring down the whole house. To understand the scale of the challenge, we must map the invisible middlemen. Between the moment a lender approves a loan and the moment a title is recorded, a dozen third-party software layers now intervene. There are the loan origination systems, LOS, the automated valuation models, AVMs, the digital escrow platforms, and the title search aggregators. Most of these services are SaaS, software as a service. They sit quietly in the middle, processing billions of dollars in volume, yet they are often invisible to the ultimate stakeholders. When we talk about a tech vendor being hacked, we aren't just talking about a website going down. We are talking about the integrity of the data that proves who owns what, who owes what, and how much a property is worth. These invisible middlemen have become the custodians of the market's truth. If the software that connects a bank to a title company is compromised, the legal certainty of the transaction evaporates. This is the systemic risk we must now analyze. It isn't just about protecting passwords, it is about the fact that the entire real estate industry has become dependent on a technological stack that is largely opaque to the people who actually own the assets. For the institutional professional, the task now is to audit these layers with the same rigor we apply to a physical inspection. We must ask, who are the invisible hands holding our keys? We begin with the concept of the resilience deficit. For those of us who have spent decades in the markets, we understand the allure of optimization. In the manufacturing world, just-in-time delivery was hailed as the ultimate efficiency. Real estate finance technology adopted a similar philosophy over the last decade. We streamlined the plumbing of property transactions to the point where capital moves at the speed of a click. But as the recent Bloomberg report regarding the FBI investigation into a major tech vendor illustrates, we have traded redundancy for velocity. In a complex system, efficiency is often the enemy of resilience. When we talk about a just-in-time financial stack, we are talking about a system where every participant, the bank, the title company, the mortgage servicer, is tethered to the same central node. Under the stress of a modern cyber attack, this centralized efficiency becomes a systemic liability. This isn't just about a temporary outage or a data leak, it is about the fundamental inability of the system to function when its digital backbone is fractured. We have built a high-speed rail system but neglected to build the secondary tracks. When the primary line is compromised, the entire economy of the transaction halts. We must honestly ask ourselves if the 3 days saved in a closing process are worth the risk of a 3-week systemic blackout. For the institutional professional, the math is starting to look increasingly unfavorable. The resilience deficit is the gap between the speed we desire and the stability we require, and currently, that gap is widening at an unsustainable rate. Moving beyond the immediate breach, we must assess the long-term institutional consequences of vendor consolidation. The PropTech boom of the mid-2010s promised 1,000 flowers blooming, yet the reality has been a rapid consolidation into a few must-have platforms. This has created a digital oligopoly where the failure of a single firm, as we are seeing explored in the current federal investigations, has a ripple effect that touches trillions of dollars in assets. For those of us over 40, we remember the too big to fail conversations of 2008. We are entering a similar era, but this time it isn't about the size of a bank's balance sheet, it's about the breadth of a software vendor's integration. When a handful of companies control the gateways for title insurance, mortgage origination, and escrow management, they become systemic risk factors. The institutional consequence is a loss of agency. If you are a fund manager or a real estate executive, you are no longer just managing physical assets, you are managing a dependency on a tech stack you do not own and often do not fully understand. This consolidation creates a monoculture. In nature, a monoculture is fragile, a single pathogen can wipe out an entire crop. In finance, a single vulnerability in a consolidated vendor's code can freeze the liquidity of an entire asset class. We have spent years optimizing for the lowest cost per transaction, but we are now beginning to pay the hidden tax of that consolidation through increased systemic vulnerability. This brings us to the horizon shift. It is time to redefine fiduciary duty for the digital age. Traditionally, our duty as stewards of capital was focused on market risk, credit risk, and physical asset maintenance. Today, infrastructure resilience must be added to that list. The shift we are advocating for isn't just a technical upgrade, it's a philosophical one. We must move from centralized efficiency to decentralized resilience. This doesn't necessarily mean blockchain in the speculative sense, but it does mean architectural diversity. It means building systems where the failure of one vendor does not paralyze the entire enterprise. It means sovereign data management, the idea that institutional players should maintain their own cryptographic keys and data backups rather than delegating them entirely to third-party SaaS providers. As informed peers, we must recognize that the set it and forget it model of tech procurement is over. A fiduciary must now be able to audit the digital supply chain with the same rigor used for a Phase 1 environmental report. This is the new standard of care. We must demand that our vendors provide not just uptime guarantees, but recovery guarantees that are independent of their primary infrastructure. The goal is to move toward a future where our financial plumbing is as robust as the steel and concrete we invest in. We are looking for structural integrity in bits just as much as in bricks. In conclusion, let us offer a sober roadmap for the professional navigating this next decade. The headlines from Bloomberg and the FBI investigations are not a reason for panic, but they are a definitive signal for a change in strategy. First, conduct a dependency audit. Map out every third-party software that touches your transaction flow. Second, diversify your tech stack. If you are 100% reliant on a single ecosystem, you are at risk. Third, reinvest in internal technical literacy. The over 40 leader doesn't need to write code, but you must understand the architecture of your risks. The next decade will be defined by volatility, not just in interest rates, but in the very systems that process our capital. Our role is to remain calm, analytical, and focused on the long-term sustainability of the market. We have seen cycles come and go, and we have seen technology change the landscape before. The winners of the next era won't be those who chased the fastest transaction, but those who built the most resilient foundation. The horizon is clear for those willing to look past the immediate noise and focus on the structural reality. This is our duty, and this is our path forward. Stay informed, stay resilient, and keep your eyes on the horizon.